KKR is a global investment powerhouse, managing money for pension funds, wealthy individuals, and insurance companies. The firm invests in companies, real estate, credit, and infrastructure, often taking control to improve performance. Its influence stretches across industries and continents, shaping businesses and entire sectors. KKR's buy, improve, sell cycle fuels growth for clients and itself, keeping it at the forefront of global finance. KKR's third quarter results for 2025 were nothing short of remarkable. The firm posted an adjusted net income of $1.27 billion, well above Wall Street's expectations. That's $1.41 per share, beating analyst forecasts by a wide margin. This outperformance signals that KKR's strategies are working, even in a challenging global economy. Strong earnings reflect the firm's skill in managing investments and attracting new capital. Beating analyst estimates boosts KKR's reputation as a top-tier investment manager. This isn't a one-off event. KKR has been building more stable, diversified sources of income for years. The record profits show that this long-term strategy is paying off. Consistent success gives investors confidence and provides KKR with more capital to reinvest and grow. The $127 billion profit is more than a number. It's proof of smart deals and a well-executed vision. KKR's performance highlights its ability to deliver value, even when markets are volatile. The firm's investment teams and business model are driving real results. KKR's financial strength positions it for continued growth and leadership in global investing. A key driver of KKR's record quarter was its massive fundraising success. The firm attracted $43 billion in new capital in just 3 months, a powerful vote of confidence from investors. Most of this money flowed into KKR's credit division and its insurance arm, Global Atlantic. The credit business alone brought in $27 billion, as investors sought steady income in uncertain markets. Private credit is increasingly popular as an alternative to traditional stocks and bonds. Global Atlantic, KKR's insurance unit, has become central to its strategy, providing stable long-term assets to manage. This diversification away from traditional private equity makes KKR's business more resilient. Raising such large sums sets KKR apart from competitors and demonstrates deep trust from global investors. Clients range from sovereign wealth funds to public pension plans, all seeking KKR's expertise. The $43 billion in inflows gives KKR more firepower for future investments and boosts fee income. This fundraising success cements KKR's dominance in alternative investments. It also ensures the firm can keep growing, even as markets shift. KKR's ability to attract capital is a testament to its reputation and results. Assets under management, or AUM, is the lifeblood of a firm like KKR. It's the total value of all assets KKR manages for clients, a key measure of its size and influence. After its strong quarter, KKR's AUM soared to $723 billion. The firm's co-CEOs have set an ambitious goal: reach $1 trillion in AUM by 2030. This target shapes KKR's strategy, from fundraising to new product development. Achieving it means more earnings power and greater market influence. To get there, KKR must grow existing funds, attract new capital, and expand into new markets. Insurance and retail investor platforms are critical to this plan, providing steady, long-term capital. Growing AUM isn't just about size. It's about building a more diversified, efficient business. More assets mean economies of scale and a broader range of products for clients. Tracking AUM growth is the best way to gauge KKR's progress and health. The journey to $1 trillion is about resilience and leadership in global finance. KKR's expanding AUM signals its rising power in the investment world. Wall Street initially cheered KKR's stellar earnings. Shares jumped 3% in early trading. Investors rushed in, betting that strong profits would drive the stock higher. But the celebration was short-lived. By day's end, the stock finished flat. Why the reversal? Investors look beyond past results. They're focused on the future. During its earnings call, KKR announced a coming financial charge tied to an underperforming Asian fund. This news injected uncertainty, prompting some investors to sell and erasing earlier gains. The episode shows how markets balance good news with future risks. Even stellar results can be overshadowed by concerns about what's next. KKR's stock performance is a reminder. Markets are forward-looking and quick to react. A single negative headline can outweigh a great quarter. Still, the strong earnings reinforced KKR's underlying strength. Investors remain watchful, but KKR's fundamentals are solid. The market's reaction highlights the constant tension between present success and future challenges. KKR's third-quarter success was driven by standout performance in some divisions, offsetting slower growth elsewhere. Global Atlantic, the insurance business, was the star. Operating earnings jumped 28%. Insurance now makes up about a third of KKR's assets, providing steady, reliable income. This stability is prized by investors, especially when markets are volatile. KKR's retail channel for wealthy individuals also surged, with assets more than doubling to $29 billion. This expansion taps into a huge market and diversifies KKR's client base. Meanwhile, traditional private equity returns slowed to 2% for the quarter, down from 5% previously. Higher interest rates have made buyouts more expensive and exits tougher across the industry. The slowdown isn't unique to KKR. It's an industry-wide challenge. Diversification is paying off. Insurance, credit, and retail are picking up the slack. KKR's balanced approach makes it more resilient in changing markets. The firm can weather private equity headwinds thanks to its broader business mix. This strategy positions KKR for consistent growth, regardless of economic cycles. Fee-related earnings are the bedrock of KKR's stability. KKR earns money two ways: performance fees from successful investments and steady management fees for overseeing client assets. The latter, fee-related earnings, are predictable and recurring, providing a solid revenue base. In Q3, these earnings hit $1 billion, underscoring their importance. As KKR's assets under management grow, so do its fee-related earnings. This reliable income covers operating costs and cushions the firm during market downturns. Even when performance fees dip, management fees keep cash flowing. Investors and analysts closely watch this metric. It signals business resilience. Growing fee-related earnings is central to KKR's long-term strategy. The $43 billion in new capital will further boost future fee income. Expanding into insurance and credit strengthens this stable foundation. Fee-related earnings act as a financial shield, protecting KKR from market volatility. This focus ensures KKR's long-term stability and success. KKR competes with giants like Blackstone and Apollo, all evolving beyond traditional private equity. Higher interest rates have made classic buyouts tougher, forcing firms to adapt. KKR's answer: aggressive diversification into insurance and credit, generating steady fee-based income. Global Atlantic and the credit division are now pillars of KKR's business. This shift makes earnings more predictable and less tied to market cycles. Each firm has its own edge. KKR excels in Asia and in products for wealthy individuals. The retail channel is a battleground, with KKR and Blackstone vying for high-net-worth clients. KKR's leadership points to recent fundraising success as proof of its appeal. The competition is driving innovation across the industry. All are racing to build diversified, resilient business models. KKR's strong quarter shows its strategy is working. By expanding beyond private equity, KKR is poised to thrive and capture market share. The firm's adaptability ensures it remains a leader in the evolving financial landscape. Despite a slower market, KKR stayed active with new deals in Q3. It acquired a majority stake in Healthcare Royalty Partners, tapping into stable pharmaceutical royalties. KKR also secured a $2 billion investment from Japan Post Insurance, highlighting its global reach. These deals show KKR's ability to find opportunities even when deal-making slows. The firm has $126 billion in dry powder, capital ready to deploy when opportunities arise. This war chest is a major advantage, letting KKR act quickly in volatile markets. Fundraising remains strong. KKR's latest North America private equity fund has already raised $17.5 billion. This replenishes dry powder and fuels future investments. Just after the quarter, KKR and Apollo teamed up for a $7 billion investment in Keurig Dr. Pepper. Such large, creative deals highlight KKR's flexible, opportunistic approach. With a robust deal pipeline and ample capital, KKR is set for continued growth. The firm's strategy and resources position it to lead in global finance. KKR's momentum shows no signs of slowing as it executes its long-term vision.